What is money? If money is viewed simply as a tool to facilitate transactions, only those media that are readily accepted in exchange for goods and services and other assets need to be considered. Many things, from stones to baseball cards, have served this monetary function through the ages. Today in the United States, money used in transactions is mainly of three kinds: currency, paper money, and coins in the pockets of purses of the public; demand deposits, non-interest bearing checking accounts in the bank; and other checkable deposits, such as negotiable order of withdrawal or NOW accounts at all depository institutions, including commercial and savings banks, savings and loans associations, and credit unions. Traveler's checks are also included in the definition of transactions money, since $1 in currency and $1 in checkable deposits are freely convertible in each other and both can be used directly for expenditures. They are money in equal degree. However, only the cash and balances held by the non-bank public are counted in the money supply. Deposits of the U.S. Treasury, depository institutions, foreign banks, and official institutions, as well as a cash vault in depository institutions, are excluded. This transactions concept of money is one designated as M1 in the Federal Reserve's money stock statistics. Broader concepts of money, M2 and M3, include M1 as well as certain other financial assets such as savings and time deposits at depository institutions and shares in money market mutual funds, which are relatively liquid but believed to represent principally investments into their holders rather than media of exchange. While funds can be shifted fairly easily between transaction balances and those other liquid assets, the money creation process takes place principally through the transaction accounts. In the remainder of this booklet, money means M1. The distribution between currency and deposit components of money depends largely on the preferences of the public. When a depositor cashes a check or makes a cash withdrawal through an automatic teller machine, he or she reduces the amount of deposits and increases the amount of currency held by the public. Conversely, when people have more currency than is needed, some is returned to the banks in exchange for deposits. While currency is used for a great variety of small transactions, most of the dollar amount of money payments in our economy are made by check or electronic transfer between deposit accounts. Moreover, currency is a relatively small part of the money stock. About 69% or 623 billion of the 898 billion total money stock in December of 1991 was in the form of transaction deposits, of which 290 billion were demanded and 333 billion were other checkable deposits. Okay, so what does any of that really mean? What is money? Money is viewed simply as a tool to facilitate transactions. Today in the United States, there are mainly three kinds of currency. So you have paper money, coins, demand deposits, and other checkable deposits. Not just cash, not just your debit card. There are more than 3 different kinds of currencies, but these are the main kinds of currencies. So when you're reading and you're seeing the Federal Reserve talking about M1, that's what they're talking about. That kind of money, those main 3 kinds of currencies: paper, demand deposits, and negotiable order of withdrawal accounts. All depository institutions, including commercial and savings banks, savings and loans associations, and credit unions. We, the people, have power. The distribution between the currency and deposit components of money depend largely on the preferences of the public. So you and your preferences demand where that money is distributed. When you hear the word currency being used, they are referring to paper money and coins in the pocket and purses of the public. And so while currency is used for a great variety of small transactions, most of the dollar amounts and money payments in our economy today, take a look around you, everybody's using a card. To wrap that all up, money is, at its very basic form, just an exchange of energy for your time for resources, basic needs, expenses, fun toys, using currency, paper money, coins, using digital deposits, negotiable instruments. These are all forms of money. And so today, now in 2025, there are more forms of money or currency in this world than ever before. And there seems to be such a fight over this resource as if it's scarce, but it's actually not. Money is abundant, it's everywhere. It's this whole world has become so transactional. If you need something, you trade it for something, whether that's currency or whether that's your time. In effect, both have the same value. Your time is, have you ever heard that phrase, time is money? This is what they're talking about. So, what makes money valuable? According to modern money mechanics, in the United States, neither paper currency nor deposits have value as commodities. Intrinsically, a dollar bill is just a piece of paper. Deposits merely book entries. Coins do have some intrinsic value as metal, but generally far less than their face value. What then makes these instruments, checks, paper money, and coins, acceptable at face value in payment of all debts and for other monetary uses? Mainly, it's the confidence that people have that they will be able to exchange such money for financial assets and for real goods and services whenever they choose to do so. Money, like anything else, derives its value from its scarcity in relation to its usefulness. Commodities or services are more or less valuable because there are more or less of them relative to the amounts people want. Money's usefulness in its unique ability to command other goods and services and to permit a holder to be constantly ready to do so. How much money is demanded depends on several factors, such as the total volume of transactions in the economy at any time, the payment habits of the society, the amount of money that individuals and businesses want to keep on hand to take care of unexpected transactions, and the foregone earnings of holding financial assets in the form of money rather than some other asset. Control of the quantity of money is essential if its value is to be kept stable. Money's real value can be measured only in terms of what it will buy. Therefore, its value varies Therefore, its value varies inversely with the general level of prices. Assuming a constant rate of use, if the volume of money grows more rapidly at the rate of which the output of real goods and services increases, prices will rise. This will happen because there is more money than there will be goods and services to spend it on at prevailing prices. But if not, on the other hand, growth in the supply of money does not keep in pace with the economy's current production. Then prices will fall. The neighbors' relations force, factories, and other production facilities will not be fully employed, or both. Just how large the stock of money needs to be in order to handle the transactions of the economy without exerting undue influence on the level price depends on how intensely money is being used. Every deposit balance and every dollar bill is part of somebody's spendable funds at any given time, ready to move to the owners as transactions take place. Some holders spend money quickly after they get it, making these funds available for other uses. Others, however, hold money for longer periods. Obviously, when some money remains idle, a larger total is needed to accomplish any given volume of transactions. So, to wrap that all up, what makes money valuable? You. You make money valuable. Every transaction that you make gives money some sort of value. And they even say, intrinsically, a dollar bill is just a piece of paper. These deposits of your dollars into the bank, merely book entries. And yes, coins may have some intrinsic value, but only because of their metal, and generally it's less than the face value of that coin. So the only thing that really gives money any kind of value is the agreement that you and I have with each other that that money has value, just so we're clear. All right, on to the next part. Who creates money? Changes in the quantity of money may originate with the actions of the Federal Reserve System, the central bank, depository institutions, or principally commercial banks, or the public. So, who creates money? The Federal Reserve System, principally commercial banks, or the public. Those are the three that make the money. The majority control, however, rests with the central bank. The actual process of money creation takes place primarily in the banks. There's a subnote here, subnote 1. In order to describe the money creation process as simply as possible, the term bank used in this booklet should be understood to encompass all depository institutions. Since the Depository Institution Deregulation and Monetary Control Act of 1980, all depository institutions have been permitted to offer interest-bearing transaction accounts to certain customers. To certain customers. Transaction accounts, interest-bearing as well as demand deposits on which payment of this interest is still legally prohibited. Oh. Transaction accounts, interest-bearing as well as demand deposits on which payment of interest is still legally prohibited at all depository institutions are subject to the reserve requirements set by the Federal Reserve, which is neither federal nor a reserve. Just throwing that in there. Thus, all institutions, not just commercial banks, have the potential for creating money. Oh, so let's repeat that. Thus, such all institutions, not just commercial banks, have the potential for creating money. So you were also included in that. Remember, who creates money? The major control rests with the central bank. However, depository institutions or the public, because we, the public, are the ones taking these notes and taking them to the bank, therefore creating money. In the absence of legal reserve requirements, banks can build up deposits by increasing loans and investments so long as they keep enough currency on hand to redeem whatever amounts the holders of deposits want to cover into currency. This unique attribute of the banking business was the banking business. They even said that in their paper, guys. I'm just reading this, and the print is really, really small. So if I'm stumbling around, this is why. I'll blame it on small print. This unique attribute of the banking business, wow, that just kind of stood out to me, was discovered many centuries ago. Because remember, it is a business. Anytime that you're interacting with them at all, you're signing contracts. Any kind of agreement with them is a contractual agreement. It started with goldsmiths. As early bankers, they initially provided safekeeping services, making a profit from vault storage fees for gold and coins deposited with them. People would redeem their deposit receipts whenever they needed gold or coins to purchase something and physically take the gold or coins to the seller, who, in return, would deposit them for safekeeping, often with the same banker. Everyone soon found it was a lot easier to simply use the deposit receipts directly as a means of payment. Well, yeah, I mean, gold can get a little heavy, a little cumbersome carrying around. So why not just make it any easier on everybody and give them receipts, which became known as notes? If you look at the dollar bills that you hold in your pocket, it says it right on there, a Federal Reserve note. So these notes are just easier to pay with, right? These receipts, which became known as notes, were acceptable as money since whomever held them could go to the banker and exchange them for metallic money. Then the bankers discovered that they could make loans merely by giving their promises to pay or banknotes to borrowers. In this way, banks began to create money. More notes could be issued than the gold coin on hand because only a portion of the notes outstanding would be presented for payment at any one time. Enough metallic money had to be kept in hand, of course, to redeem whatever volume of notes was presented for payment. Transaction deposits are the modern counterpart of banknotes. So transaction deposits are the modern counterpart of banknotes. It was a small step from printing notes to making book entries crediting deposits of borrowers, which the borrowers in turn, could spend by writing checks, thereby printing their own money. That's right. You write a check, you print your own money. So money is not scarce, it's abundant, it's everywhere. You literally have the ability to make it yourself, to create it yourself. And it says over here in their very own paper. So that is part 2 of modern money mechanics. And we'll keep digging if you're interested. Stay tuned.